this computer. Okay.
All right, and feel free to jump in if you have questions. Suzanne is recording it, and of course it won't go very far. If we get 5 people to view it, I think that would probably exceed my expectations. But so if you have questions, feel free to jump in. What we were going to talk about today is using bonds in a Boglehead portfolio, or really any portfolio, and what role do bonds play? I'd never suggest someone have 100% bonds in a portfolio, just like I would never suggest having 100% stocks. So how do they work together? What's the purpose? And what role do they each play? So just to set the stage, because I don't know how familiar folks are with bonds, but at its very core, a bond is just an IOU, and you're lending money to someone. In this case, we're mostly talking about government bonds. So you're lending money to the U.S. government or another government, and they agree to say, okay, we'll pay you X%, and then we'll pay you back on a certain date in the future. And that might be next year. It might be 30 years from now. It just depends on which one that you want to invest in. And so the real simple scenario there is, let's say you have $10,000, you buy a $10,000 bond with a 5% coupon, and then that would pay you $500 a year, and then you would get your $10,000 back at the end of the term. So that's the real basics of it. But in a mixture of a portfolio, what role does it play? So I thought, it really comes down to 3 things. One is stability. Bonds are typically much less volatile than stocks. If you look at stocks, you're going up, I don't know, 20% this year. The next year it's down 20% or up 15%, down 15%. So we have this really rough roller coaster. Now, hopefully, with stocks, that roller coaster eventually goes up and to the right, but it can be a rough ride. And so with stocks, it's much less of that. The incline is not as steep. We don't expect 30% years, but we also don't expect 30% losses either. And so I think of it also as kind of like shock absorbers, right? You put the shock absorbers on your car. So when you hit that really bad divot in the road, pothole, you don't take the full brunt of that force. When you're not hitting potholes, you don't really appreciate the value of those shock absorbers, but when you hit one, you're glad you have them. So that's number one, is stability. And actually, I've got an interesting point there, but I'll come back to it once I go through all these other couple here. The second is income. When you get to a certain point, and Matt and I had dinner the other night and talked a little bit about this. He and I are both kind of starting to think about like this part of life where you go and you go across from accumulating into decumulating, right? And you start to put your portfolio into reverse. And so bonds can be used as an income stream to provide predictable income, almost like a paycheck or an annuity. You can do that with bonds. And the third is diversification. And I think all of us, by the fact that you're on this call, means you're probably somewhat familiar with diversification. It's kind of a core Boglehead philosophy. You don't put all your eggs in one basket. You don't buy just one stock. You mix it up a little bit, and you get a little bit of each thing. And a really important piece of that that might take up 10%, 20%, 30% of your portfolio is this bonds piece. I've got a sub bullet there, and I'm curious if anyone has some insight on this, and we'll talk about it later, certainly, because it's an interesting concept. But if you add bonds to your portfolio, it can actually increase, even though your returns will be projected to be lower. Your projected safe withdrawal rate will be calculated as higher. Anyone have an insight on why that is? All right, you got a quiet group. It's because of the volatility. So when you're thinking about safe withdrawal rates, when you're thinking about decumulation, you have to think about what's the worst thing that can happen. What do I have to plan for? What if I hit a Great Depression, or what if I hit stagflation? And you're thinking about what's the safe thing that I can do in this safe withdrawal rate. By adding bonds, we talked about shock absorbers, you reduce the volatility, right? You close in on the bottom and you close in on the top. And it's hard to give away the top, right? It is, because you're saying, well, those are potential gains. But what you get in return is you don't have the expectation, at least, of big dips. And so when you calculate that out, it actually increases your safe withdrawal rate that you can calculate out for the future. Bonds, of course, have risks. I came up with 4 here. The first one is default risk. Default risk is just what it sounds like. It's you give them money, you loan them money. Oh, somebody's saying they can't see the slides. That is my fault. I think I got distracted here. Let's see. I want to make sure I get that shared. Can you guys see that now?
Yeah,
Yes,
that
we
worked.
can. Thanks, Dan.
All right. My bad. You didn't miss much. If I go back, let's see. Yeah, we just did a couple of slides. We talked through it. So what are the primary risks? So number one is that you don't get paid back, right? And so obviously, if you're loaning money to Toys R Us a few years ago, or Sears, or some of these that have been really, really high profile bankruptcies or restructures, that's going to be very volatile. That's going to be very risky. Now, of course, they pay a higher rate, but that's not really what I'm in this for, right? If I want to take a risk and potentially get paid for it, the research shows that the way you do that is with equities, with stocks. So I typically am looking at bonds as a safety measure. And so I'm looking at highly respected governments. So that's typically US or Europe or something like that, or AAA rated companies. The second one is interest rate risk. And so we say, well, how's that a risk? Well, the risk is if you buy bonds and you go in hard at, okay, the bonds are paying 4%. That sounds great. I'm going to go really long term. And then let's say interest rates go up or inflation goes up to 5%. Suddenly those that you bought at 4% don't sound so great anymore, right? And so their market value, their street value is going to go down. And that's why we have that seesaw effect where when rates go up, bond prices go down, and when rates go down, bond prices go up because of that seesaw effect. So how do we mitigate that with interest rates? Well, one thing you can do is you can buy bonds of varied maturities, because the shorter the maturity, the less sensitive they're going to be to interest rates. So if we say it's a 1-year bond and rates go sky high, well, it's not that big of a deal, right? Because it's going to mature in a year. So it's not as risky. If you go in for 30 years and rates move around a lot, well, you've got that thing for 30 years. So the price is going to be much more volatile. But there's trade-offs, of course, right? There's always trade-offs, because sometimes you might want to go long-term because you've got an event in the future that you want to get paid, until a certain date. Or maybe you're like, you know what? I don't care what the market does. I'm satisfied with this rate. I'm going to lock it in for the long term. That's valid too. So there's always trade-offs. So similar to inflation, interest rate risk is inflation risk. If you buy it here and inflation goes sky high, then maybe that rate doesn't sound so good anymore. One thing that we can do there, we're going to talk about this as we get into it, is inflation protected bonds, which I love because it mitigates one of these risks. The US government puts out inflation protected bonds that, I wish they would phrase it this way. They don't, but essentially is this: it's inflation plus X. So it's, inflation plus 2. Great. I'll take inflation plus 2 or inflation plus 2.1 or whatever it is. And the final one is currency risk. If you buy a bond outside of the US, let's assume for this example that you live in the US, you spend dollars in US dollars, but you were to buy bonds from France or Spain or Belgium or somewhere like that, and they're on the euro, and maybe you make 6%. But if the US dollar and euro were to move around a little bit and suddenly euros aren't worth as much, then that would be currency risk. So those are the 4 sort of top risks that I would think about with bonds. And of course, everything has risks, and you do your best to mitigate them. So how do we mitigate currency risk? Well, if you live in the US and you spend money in US dollars, the way you mitigate that is you buy mostly US bonds or mostly US dollar denominated bonds. Now, I do have some international ones. When you do that in a fund, they can actually take that currency risk. They can hedge that using some currency futures. And so they can handle, that's another way to mitigate it, would be to use a bond fund. So bonds as shock absorbers, we talked about this a little bit. Let me see if I can get I usually use Teams, so I don't use Zoom very often. Let's see if I can get a highlighter or something going here. Okay, that's a marker. Okay, that'll work. So I did a couple of examples here. So I did portfolio 1 and portfolio 2. And I did this with Portfolio Visualizer. And what I like, one of the things I love about that tool is you can create something and then you can link to it. And so if I send out this deck later, you guys will be able to click on that and see these exact numbers and get into the tool using exactly the assumptions that I had here. So I ran a, what is that, 40-year window. And I said, let's start with $10,000. Now, in the 100% stocks scenario, I did end up with more money, but that's the benefit of foresight. We don't know that, right? If you're sitting in 1984, you just came out of the 70s, you don't know if the stock market's going to be great or the stock market's going to be bad. But if you did 100% stocks in 84, you would have gotten 11% compound annual growth rate. But you would have taken quite the ride, right? You would have taken a 15.5 standard deviation. So in about 60% of the years, you're somewhere between 25% and -5. And if you broaden that lens a little bit more, you might be up to 40 or down to -20, right? That's a really rocky road. And in fact, you see that here. The best year was about 36%, and the worst year was about -37%. Oh man, that is like, for me, that's heartburn, right? And at one point, you had a drawdown, sort of a continuous drawdown of you lost half your money. And that's just in our lifetimes, right? I mean, that's 40 years. And these have been good years. But still, you had to be prepared to lose 50%. Now, I did the same thing here, same time period, and I split it 70-30. And how do you pick 70-30? I don't know. I made it up, right? Some people say buy your age in bonds or your age minus 20 in bonds. To me, it's more about where you are in your life. You know, how much volatility can you absorb? What's your risk tolerance? Things like that. But for sake of argument here, I did 70-30. Well, I ended up with less money. And so that's something you definitely want to take into consideration. So this person has less by quite a bit, right? I mean, 200K difference. So that's definitely something to think about. But this is interesting. They got a 10% return, but a lot less volatility. So in their max drawdown, they only lost a third, whereas their guy here lost a half. His best year was still pretty good, but his worst year wasn't nearly as bad. And so depending on where you are in your life, and are you planning for retirement? Are you planning to take money out? Are you planning for a safe withdrawal rate? Are you saving for, I don't know, a house down payment? Or I saw someone the other day, and this is not a great scenario, obviously, but they said that they had this was on Reddit or Facebook or something, that said they had a progressive illness, and they thought that, at most they would have 10 years left in their life, and how would they plan for that? And my feedback on that post was a 10-year tips ladder, because you would know without a doubt, here's what I get in year 1, year 2, year 3, year 4, year 5. And that way he would have exact knowledge of what that income could be over 10 years. So I think I probably answered my own question here about why would you get excited about a lower compound, the CAGR here, the compound annual growth rate. Why would you get excited about that? I think I answered it because what you lose in upside, you gain in less volatility and a little bit more assurance that you're not going to get just killed with a 50% drawdown, which I would assume would be really painful. Anybody have any questions? And we've got some, for Suzanne, there are people in the waiting room. I don't know if you can see that.
I'm just curious, in setting up a bond ladder, I just finished reading the book Annuities for Dummies, and they compare buying bonds versus annuities. And one of the things about annuities, like if you get an immediate income annuity, you set it up once and then it lasts the rest of your life. Where with a bond ladder, it sounds like you have to kind of manage that. Is there any way to set up a bond ladder so that as you get older, you're not trying to figure out how to manage it, that you can kind of automate it?
Yeah, definitely. I mean, especially if you've got less than 30 years that you're trying to plan for, that you could say, okay, maybe I don't, maybe I've got 20 years left in my life. I want to plan for 20 years of income. Or maybe you pair those two things together and say, I want to create my own annuity for the next 20 years. And then when I'm 85, I'm going to buy this immediate annuity at that time to take advantage of the mortality credits that annuities offer. So yeah, once you set it, it's kind of like the old the Ronco rotisserie chicken, set it and forget it. So yeah, that's the idea here that we'll talk about in a minute. All right, let's move on then. So what does that mean for safe withdrawal rates? I probably spoiled this slide because we talked about it so much on the last slide. But because we're reducing the volatility, we can actually plan to take a little bit more on the safe withdrawal rates than we would otherwise. Because if you have more volatility, you have to be more careful and more conservative when planning the volatility. This is interesting because I ran some numbers on this, and so I did $1 million starting balance. Let me go back. How do I get my pen back here? Let's see. All right, so $1 million starting balance, and in one scenario I did a 60-40, and I did 10-year treasuries. And again, I put links here, so if I send you these slides out later, you can click on these and it'll take you into that. So we want to know is, what's the safe withdrawal rate in the worst scenario? So in the lowest percentile, right? Everybody knows if you're looking at the best stuff, your safe withdrawal rate would be high. But if you say, yeah, but what about the worst case scenario? In this scenario with 60-40 and a 30-year window, the safe withdrawal rate was 4.49. The same thing with 100% stocks. Because the worst case scenario is worse, so the worst is worse and the better is better, or the best is better, the safe withdrawal rate was lower, even though these numbers are different, right? Remember, you're giving away some of your possible gains in order to shore up your possible losses. So it's always a trade-off. Any questions on that before we move on?
Just another one. In one of the books I read, it kind of showed different allocations, and it really wasn't that sensitive whether it was like 30, 40, 50% bonds. I think the message there was that you just should have something in bonds. And I think it's probably because you're not withdrawing money from your stocks, say, when the market's down, that you can keep that money invested. For you, in your like simulations here, is there like a minimum that you would put in bonds just to make sure that you're protecting your stocks?
I mean, I don't know the answer to that. I think it's probably a curve of some sense, but to me, in that 20 to 40 or 20 to 50 range is where the right answer is. And I really liked a quote I heard recently that said there's no perfect portfolio, but there's lots of perfectly fine portfolios. And so I don't know what the right answer is, but some portion of your portfolio in bonds makes a lot of sense. I think most planners would agree to that, but no way to know what that number is. But Portfolio Visualizer is actually a really cool tool because you can do portfolios next to each other. And so like, an interesting case study might be to go 10, 20, 30, 40, 50, set them up next to each other and see how much that affects how much of the top end are you giving away and what's the trade-off on the bottom side? How much are you protecting yourself for giving away that top side? I don't know. I haven't run those kind of scenarios, but I think it'd be fascinating. Christine Benz is pretty well known in the Boglehead world, and so I thought I would include one of her quotes because she was talking about this on a Bogleheads live podcast, and I thought it was a pretty good fit here because she said, you know, it's somewhat counterintuitive that the best withdrawal rates are delivered. Withdrawals are delivered by a balanced portfolio. You would think that you would get oh, more stocks is better, and she said, yeah, but it's not, right. It's counterintuitive. The bonds have a lower return assumptions, but they're much more stable and predictable. So exactly the same thing we just talked about, that they did that research and kind of came to the same conclusion. TIPS are something that I mentioned these earlier. TIPS are a government bond. A lot of people think of bonds in what they call nominal terms. In other words, without a consideration of inflation. TIPS are quoted in real terms. In other words, inflation plus some number. So it's that number above inflation is your real number. There's two things that the government does here that have inflation protection. One is TIPS and one is I bonds. And someone posted on Facebook in my local group the other day. He said, "Oh, I don't know much about bonds. I just know I bonds." And I said, "Oh, we're going to trash talk I bonds a little bit." Because I really think that that TIPS are better than I bonds for a couple reasons. One is that you're not limited. I think I bonds are limited to something like 10 or 20,000 a year. I think it's 10 per person, 20 per couple, something like that. You have to buy them through the Treasury Department, which is a really bad website. Because I did buy some I bonds a few years ago, and I was like, this is horrendous. But TIPS are you buy them through your brokerage. There's no limit. It's like a stock. You know, they're not going to say you can only buy X dollars of stock. So you just buy it through your brokerage. And right now, and I don't know if this is always the case. In fact, I assume it's not always the case. But right now, TIPS are paying more than I bonds. And so why in the world would I buy an I bond when I can buy a TIP that's paying, you know, like 0.8% more, which is pretty significant. You know, you're talking about for doing nothing to get almost an extra 1%. And so they adjust every year. And so it's really hard at one point to get your mind around this, because let's say you start with $1,000 and you have 3 and a 2% coupon. So at the end of the year one, it will pay you, let's see, so it'll pay you 200, and the value, the principal value, then gets adjusted for inflation. So now your principal is 10,300. And so next year it pays you 200 plus the percentage of the whatever it gains. So maybe it's like 210 or something. I don't know. I'm not looking at numbers here, but and then the principal grows again. And so every year the principal is growing for inflation, and the amount that it's paying out is growing by inflation. So it's really powerful when you start thinking about creating retirement income that's going to say, hey, I need 50K a year now, but I don't know what it's going to be next year or the year after or the year after. And if you set this kind of wheel in motion, you're getting 50,000 and then 54,000 and then, you know, 58,000 or whatever inflation is, it is. And you're adjusted every year. So it's a really neat thing here. Let me go back to my pen. Let's see if I can annotate. I put this in here. So we kind of know where we are in inflation. Obviously, we're not here. When I was a kid, you know, inflation was really high. And then we got to the point where we would say, man, do you remember the days when you could go and get a savings account at 5%? You know, and we were down here and no one thought you'd ever see 5% again. And now we're back up here. And so, you know, we're probably a little above average, but we're not crazy high. We're not crazy low. This is kind of where the US runs. We don't know what the future holds. Argentina, I mean, you're talking really, really high double-digit, 3-digit inflation. And Argentina is a very, you know, first world country. We have someone in our local group from Venezuela. They're dealing with 3-digit inflation. So that's just one of those things that we have the ability to mitigate, assuming our government pays its debts, you know, and its IOUs in the form of bonds. That this is a way to protect ourselves against that. Let's see, I'll have to clear my drawings here and then go to the next slide. It's so strange that it makes me clear the drawings. Like if you go to the next slide, it just keeps them on there. So bond ladders, we talked about a little bit a few minutes ago that bond ladders are a way to set up a series of bonds So let's say we wanted to do a 5-year bond ladder. In year 1, you've got 5 bonds that are paying up the chain. So you've got 5 bonds. Number 5, number 4, number 3, number 2, and number 1 are all kicking off income. And then at the end of that year, you've collected that income and you spent it because that's your retirement income. So now you've got 4 left. So now you've only got 4 kicking off income. Next year, you take that, you spend it because it's your retirement income, and you got 3. And so every year, you've got fewer and fewer that are paying you back. Now, if you're not in a position where you're taking it as income and spending it, maybe you just keep that bond ladder going and you roll it over. And so what was year 5 now becomes year 4, and you buy a new year 5. Or maybe you're working on a 20-year ladder, 25-year ladder. It's a really powerful concept. But again, anytime you do something like this, especially with large amounts of money, you're gaining certainty, you're gaining stability. What you're losing is potential upside. And so that's why I never go into something 100%, because I don't want to trade away all the potential upside. There's opportunity cost there. If I say I'm not going to be in the stock market for the next 30 years, that'd be crazy. But maybe I take a little bit and I go over here and I create some stability for myself. So, that's the idea here that I wrote about, building a floor of retirement income, right? Build that safety net for yourself. So we do have a couple of ways we can buy bonds. One is individual bonds, right? You can say, I want this one and this one and this one, and that works really well for buying bond ladders. But bond funds are so much easier. And so there's pros and cons. So the pro to individual bonds might be, theoretically, you don't lose if you hold it to maturity, although I might argue that you would have some opportunity costs there, because if you're holding it at 4% and the market is 5%, then you're still losing even if you don't see it. You can easily build the ladders. It's easy to conceptualize because you can zoom in on one bond at a time. But the cons are they are less liquid. I mean, you can still sell it. It's not like selling a house or anything. I mean, you sell it in your brokerage account, but the spread between bid and ask is going to be bigger. And so that means you might not get, top dollar for it because there's not as big of a market for that individual bond. It's also hard to build that diversification, right? Because you would have to, just like we don't go out and build our own mutual funds. We don't buy the S&P 500 manually. It'd be really hard to do that, not really practical. So it'd be really hard to do that with bonds. So bond funds, on the other hand, you do get the diversification. The bond fund manages what they call the duration, which is not, it sounds like, oh, duration means how long it lasts. Nah, not really. Duration is sort of how long they last, but it's also a measure of how sensitive it is to inflation or interest rates, actually. The bond funds are also very liquid. You can buy ETF, Vanguard total bond market, right? Super easy. You buy it in 1 minute and sell it in 1 minute. But the cons are, and I've had a really hard time with this personally over the years, it's so hard to conceptualize what's happening inside a bond fund when you update your portfolio and your bond fund has gone down 5%. And you go, wait a second, how did my bonds go down 5%? Are they still paying me? It's really hard to conceptualize that because, like we talked about earlier, if rates go up, the price of bonds goes down. And so you feel those movements a lot more when it's in a fund, even though it's exactly the same at the end of the day. It's just very hard to wrap your head around, and I've struggled with that myself sometimes. Any questions before we get into a little bit more on ladders? I know we've got about 14 minutes left here.
And I think someone asked something similar, but I remember there being something about identifying your efficiency curve or essentially like the best allocation for your portfolio using a tool of sorts. Is the tips ladder the best way to identify that for your portfolio, or is there some other tool that you use?
Are you talking about the efficient frontier?
Yes, sorry, efficient frontier.
I mean, that's the concept, right? Is that in the efficient frontier, you've got, I don't know if you guys are familiar with this, it's kind of a curve that comes around and it says, I want to be on that frontier that says, I want to get the most return for each unit of risk that I take. So whatever that amount of risk is, if I take X amount of risk, I want to get the amount of return that I should get with that. I don't want to take less return and have the same amount of risk. And so, yeah, it's actually been shown that a stock bond mix can push you towards that efficient frontier, that 100% stocks is actually riskier than it needs to be for that whatever unit of return. So that's an interesting thought. But yeah, that's why I said earlier, like most planners would agree that you have some bonds in your portfolio, whether that's 10% or 40%. I don't know. Depends on you and depends on how much risk you're willing to take. But somewhere in there is the right answer. I also see that SN asked about ETFs for tips. Yeah, that's kind of what I was. I don't know. Maybe you read this before we got to the slide. Oh shoot, went ahead. Let's see. Let me go back. Let me go back. Yeah. So it is much easier, and I like them actually. That's what I've done too. I've bought some tips ETFs, and then I've got some longer term tips. And what I did was I was trying to come up with a duration. I wanted to get to a certain duration. And so mathematically, I worked it out. And I said, if I buy a tips ETF, and I bought SCHP, I believe was it's a Schwab tips fund. And it had a duration of like 7 or 8. And then I bought some individual tips that had a duration of about 25. And then I merged them together to get about what I wanted, which for me was about 13. And you say, why 13? How'd you come up with that? Well, because I have about a 23-year time period between now and when I believe I'm going to claim Social Security. And then rough rule of thumb, you take half of that. If you say I want to pay myself for 23 years, take about half of that, 16, 17. That's what the duration of that ladder would be. And so I wanted to sort of simulate that or create that synthetically. So a tips ladder is very difficult to build unless you have some really cool Bogleheads who go out and write a tool to allow you to do it instantly and effortlessly. And so someone did that on the Bogleheads forum a year ago or so, and man, what a great tool this is. And so I put together a couple of ideas here, and this is the last 2 slides that I have. So what I did was I said, let me build a portfolio. And let me go to my pen here. So I'm going to do $30,000 a year. I want to pay myself $30,000. And I want it to start next year in 2025. And for this example, I want to go a really long time. I want to do this for 30 years. And I chose 30 years for a reason, because I wanted to show you something. In a typical retirement conversation, people throw around the 4% rule. They say, oh, if 4%, and what they should also say is for 30 years, because that's where it was tested against. 4% for 30 years was the if you went 100% tips, which I think would be crazy, but if you did, you could actually do a 4.5% withdrawal rate and know exactly what your income is going to be inflation adjusted, for that 30-year period. Why? Well, because you're not getting the potential upside. You're trading away that upside for less volatility. And so you would have assuredness that you would have 4.55% withdrawal rate. Based on when I pulled this, which you can see was using data from the 3rd, so that was a couple days ago, when it averaged out the rates, when you bought all these tips in the tips ladder, it was paying you inflation plus 2.18%. And so, okay, that sounds pretty good. Let's do it. Let's build the ladder. So how do we do it? And I've got to clear this out for some reason. Clear drawings, exit. All right, and then go to the next slide. So this is what it looks like when it spits out the tool. Oh, we didn't pay attention to this number right here. 660,000 is the cost to purchase. So if you wanted to do this, $30,000 a year, inflation adjusted. So it's going to be 30,000 and then 32,000 or whatever the number is. So always inflation adjusted. It'd be 660,000 up front, and that would give you $30,000 a year times 30 years. So what does that look like? It builds it for you and tells you exactly what to do. Let me go back to my pen here. So it's going to get it as close as it can. These numbers here, it's not exactly 30,000, but it says you buy 13 of these and 15 of these and 17 of these and 20 of these and yada, yada, yada. And then it just starts spitting it out. $30,000 a year. And what's so interesting to me is I started thinking about this one day and I was like, it's really cool because you get $30,000 a year, but every time that you get one, there's then less money here. Less money is coming from interest and more of it is a return of your principal. And I said, this is a mortgage. This is exactly what you do when you buy a house. In that case, the mortgage lender is the person lending the money. Like in this case, we're the person lending the money. But that mortgage lender, they lend you the money. And in the early days, what are you doing? You're paying more interest and less principal. And as you've been in that house for 5 years or 10 years, every time you make a payment, you're paying a little bit more principal, a little bit more principal. And the way that amortization table works out, and this is just the math of how it works, as you get further into it, you're paying more principal and less interest. Now take that and reverse the entire scenario. Now you're the one lending the money to the government or whatever entity. They're going to pay you $30,000 a year. This is the mortgage payment they're paying you, $30,000 a year. In the early days, they're paying you a lot of interest, 9, 8, 7, 6. And then as it goes on, and I didn't show the whole table here, but it goes basically to 0. And the principal, goes higher and higher as they get towards the end. And that's just mathematically how they get it to work out. In this case, the 30K a year. So that was like, oh, my eyes were open and my light bulb went off. I said, that's how this whole thing kind of works. It's a mortgage. It's just the opposite of how we typically think about it, because we're the ones collecting the payments instead of the bank. So that's the last slide I've got here. What questions do you guys have? Or hopefully I can answer. I don't know. Steve, you might have to jump in too. I might have to lean on you a little bit.
Dan, that was a good question in the chat. Oh, sorry.
That last table was great, Dan. Oh, wait, sorry. I got to put my mic on. I really enjoy that table and your analogy to a mortgage and kind of being on the other side of it.
Yeah, I know. Isn't that an interesting, like I was working on this and this is not an insight I've had for years or anything. This is an insight that I had this week and I was like, oh my gosh, this is
Yeah.
exactly why when you look at these two columns here, that's how they're related. It's exactly the way that we've all been conditioned to buy a house. It's just the reverse math. Someone asked about taxes. These are not muni bonds. Muni bonds are very tax advantageous and you get a lower rate. So these are taxable if you hold them in a taxable account. Some people say hold bonds in a tax advantage account like an IRA. There's two schools of thought on that, because some people say hold stocks that have more potential for appreciation in IRAs. And so, I don't know if there's a proven best way on this, but no, they're not tax advantaged on their own.
You could put a caveat as far as federal tax advantage. They are, if you happen to live in a state that has income tax, you're not obliged to pay state income taxes.
You know what?
on-
I've been so
on this
conditioned. I've been so conditioned now from my time away from North Carolina, because we don't pay state income tax in Florida. So that's my commercial for coming to Florida. But you're right. I think there are some state income tax benefits on these. I'm not 100% sure on tips versus.
Yeah, it's 100% sure that any U.S. government obligations income from tips,
Awesome.
the state that charges income tax is happy for anybody that does choose to pay them. However, you're not obligated to pay.
That's a really good tip. Yeah, no, I
So-
didn't even think about that, because again, Florida, Texas, Tennessee, and some others have figured out how to charge tourists to come see Mickey Mouse instead of instead of charging a state
Right.
income tax. So we get a free pass on that one down here.
Can we see the last row of your table?
You can, but I didn't paste it in.
Oh,
But
okay.
what
No
I can
problem.
do is I can show you guys how to get to it. Why don't we just do that here? Let me stop sharing, and we'll just go live, because we did this. Let's see. If I go to tips. All right, and let me share again here. All right, this is one that I had up. So I think I used slightly different assumptions here. I said start in 2025, give me a income of 80K, do it for 23 years. So this is just for me personally, because like I said earlier, I'm thinking ahead. I'm turning 47. I'm going to claim Social Security at 70. What if I wanted to build myself an income for 23 years, to match that Social Security date? And so I've been playing with this a lot myself. And so then you see the same thing happens here. The principal goes up, the interest
Can you
as
share
you
your
get towards
screen?
the bottom. Is it not sharing?
Try again, Dan. Here it comes.
Let's try that. Again, I use Teams during the day, so Zoom is always a little, I have a little learning curve here on Zoom, but yeah, so this is a 23-year ladder that says, okay, you want 80K a year. Over here on the right side, total income would be 80K. You see interest starts high and goes low, and then the opposite for principal. And so then it tells me, if you wanted to buy that 23 years of 80K inflation adjusted, it would cost you 1.46 million today. That's inflation plus 2.11. And that's pulled in real time, which is what I love about this tool. You don't have to go tell it what the rates are. It goes out and says, what's the current rate for tips? And again, this is a 23-year ladder that I'm making in real time here. So you could always go back.
So,
And you could
so Dan,
different assumptions.
here in this example, you're getting roughly 80,000 a year coming off of it. But in the early time, you're sharing a much larger percentage of that $80,000 with Uncle Sam. So
Here, let's go back
would
to
they,
that example. So 80,000 for 23 years. And so
would
you're
there
right.
be
You
an,
would have this column here,
y-
this interest income column. Is that the one you're talking about?
yeah, so you're gonna, let's say maybe a taxpayer might be spending 15 or 20 or some percentage based on their marginal tax rate or um, in taxes. So the tax burden on this taxpayer related to this ladder is going down every year. Would that be an
Good
argument
one.
to actually tilt this table and actually have a little more income in the beginning and then a little less later in order to have the roughly the same after tax cash flow every year instead of a
That's a really
increasing cash flow?
that's a really cool idea. I've never thought about that, but you're right. Because you would only pay tax.
Unless of course it's in an IRA
Right,
or
exactly.
something,
Well,
but
you would only pay tax on this column here, right? So I guess depending on
yeah.
what bracket you're in, you might, and again, if you're in a situation where this is your only income or you have other income, but yeah, I see that. I think you could tilt it just enough to make this is total income on the right side. And I don't have
Yeah,
the
to make maybe add an after
right, and
tax
after tax income would be like
guesstimated income.
a next column over. That'd be a really
Yeah,
cool feature for this. Yeah, you'd have to. I don't know. Maybe
but
we
there's
can
so many
talk about
unknowns as far as tax rates, both from a personal perspective as well as a federal
that.
perspective
Yeah.
over
My
that
hope
time.
is that
It's a
in
lot of
retirement,
unknowns.
I would hope that I'm pretty darn near zero taxes if I manage things well. Maybe not exactly zero, but maybe I'm in
Yeah,
a very low tax bracket, and so hopefully that won't make too much of a difference. If you pay 15% of 21,000, you're paying a couple, $3,000 or something.
3,000.
Back.
Yeah.
So yeah, that's a cool idea though.
There's a question in the chat. I think it's good. Is the column on the right there not adjusted for inflation?
Yeah, this is in real terms.
Okay.
So everything's always in real because we don't know what inflation is going to be. So, and they try to get it as close to 80K as possible, but it's not always exactly possible because of the way the bonds come in denominations. So they're trying to get it exactly there. But yeah, this is 78,615 in today's dollars, but since it's 2031, it would actually be like 92,000 or something. Yeah. What's interesting, if you guys really want to nerd out, there's 2 or 3 things you can do here. One is the show details that opens up a little bit more detail. Or if you really want to go into it, and I won't do it here, but you can click on the rung decisions and you can see the thought process, so to speak, that the program goes through to try to find these numbers, to try to make it come out, which I thought was pretty cool. So this isn't my tool. Like I said, it was written by someone in the Boglehead community, and I've just kind of latched onto it as kind of a fun thing to play with, because it helps me think about worst case scenario. It helps me think about creating a floor of income. And like I know I said earlier that Matt and I had dinner a week or so ago, and you know, I know that he said that he went home and played with this too. So it's one of those things where you start thinking about, all right, well, if worse comes to worse, and I want to create some income, and I want to have a floor of 30K or 40K or whatever it is that I want to make sure that I've got, that's my absolute safety net. You could do that, and you could kind of pre-purchase that, so to speak. And I love that idea. Anybody else? Hey Hugh, I saw you poke in there at the end. We did record this though, so I can send you a recording of it later.
This has given me a lot to think about.
Good. Well, I appreciate it, guys. If nothing else, we'll stop the recording here, and I will. Let's see, how do we do that? Stop video? No. Stop sharing.